All right, let's dive right into this. Welcome to The Explainer. Today, we're laying out a complete foundational blueprint for anyone gearing up for the Lok Sewa exams. We're talking about Nepal's banking system. By mapping out these complex regulations and timelines together, we're going to uncover exactly how money actually moves in Nepal. And more importantly, we're going to give you the exact tools you need to walk into that exam room with total confidence. To really get this, let's anchor everything on a remarkably powerful metaphor. Think about it like this. The economy is a living body, right? And money is the blood. That makes financial institutions the heart and the blood vessels. Their entire job is to collect money from where it's just sitting around idle and actively pump it to exactly where it's needed, out to industries, to agriculture, to everyday folks. Because without this system, savers don't have a safe place for their cash. Entrepreneurs literally can't get capital to start businesses. The heart just stops, and the economy essentially dies. So here is our game board for today. We're going to cover 5 key areas. 1, the foundation. 2, the players. 3, the language. 4, the lifelines. And finally 5, the strategy. Starting things off with part 1, the foundation. Okay, check out this timeline. We start way back in 1937 BS with Nepal Bank Limited, which was the very first commercial bank. But then we jump to 1956 BS. That's when the Nepal Rastra Bank, the central bank, was actually established. And this perfectly illustrates a wildly surprising fact. Nepal had commercial banking activity for 19 full years before it even had a central bank to regulate it. Kind of crazy, right? Then we see the Rastriya Banijya Bank pop up a bit later in 1966 BS. And finally, skipping ahead to the modern era, we have the reenactment of Bhatia in 2017 BS, which is the main act governing the system today. Moving right along to part 2, the players. So under the Bank and Financial Institutions Act, or Bhatia for short, the Nepal Rastra Bank licenses institutions into 4 very distinct classes, A, B, C, and D. Class A are your massive national commercial banks. Class B are development banks, and they have a more regional focus. Class C, those are finance companies handling everyday consumer finance. And Class D are microfinance institutions that specifically serve the deprived sector. Now, here is a crucial insight for your exams. The NRB frequently tweaks the exact rupee capital figures required for each. So instead of stressing out and memorizing those exact numbers, it is so much safer to just memorize the relative scale. A is bigger than B is bigger than C, and C is bigger than D. Now, what's really interesting about this slide, and this is an absolute lifesaver if you ever freeze up trying to remember the order on exam day, is this brilliant little memory trick. Just think to yourself, a big company delivers. A for commercial, B for development, C for company, well, finance company, and D for microfinance, which delivers to the grassroots. It's a ridiculously simple hack, but I promise you, it works every single time. All right, pay close attention here because this is a massive exam trap waiting to catch you off guard. You absolutely must know the difference between banks and non-bank financial institutions. Banks, meaning classes A through D, take deposits and are strictly, heavily regulated by the NRB. But non-bank financial institutions, like insurance companies or the Social Security Fund, they are entirely separate animals. They are not regulated by the NRB at all. They have their own specific acts and completely different regulators. Do not mix these up when you're staring down those multiple choice questions. That brings us to part 3, the language. Let's decode some of the technical jargon the NRB uses to keep these players in check. First up, the capital fund. Just think of this as a bank's ultimate emergency savings account. It's neatly split into 2 tiers. Tier 1 is core capital. This is the absolute highest quality money a bank has, like its paid-up capital and retained earnings. Then you have Tier 2, which is supplementary capital, things like general loan loss provisions. Together, this fund is the crucial buffer that absorbs financial shocks and protects everyday depositors long before a bank ever goes bankrupt. And that actually leads us right into our next concept, loan loss provisioning. Think of this as a ladder showing the timeline of a loan going bad. At the top, you have a pass loan. Everything's perfectly on time. But then it slips down to watch list, then substandard, doubtful, and finally it hits rock bottom as a loss when it's over 12 months late. The kicker here? For every single step a loan drops down this ladder, the NRB literally forces the bank to set aside a larger and larger percentage of its profits as a safety buffer. It's an incredibly brilliant system because it forces banks to be brutally honest about their actual credit risks. Okay, here's another pair of terms that look incredibly similar but are completely different beasts. First, the CD ratio, or credit deposit ratio. This basically measures a bank's lending aggressiveness. It acts as a strict limit to ensure banks don't just go wild and lend out every single rupee they hold. On the flip side, there's the CRR, the cash reserve ratio. This is a mandatory, non-negotiable chunk of cash that banks absolutely must park at the central bank. The NRB uses the CRR like a dial to control national inflation. Conflating a simple lending limit with a central bank cash reserve, that is a fatal exam mistake. Know the difference for sure.
Let's move to part 4, the lifelines. So what happens when things go seriously wrong? First, we have rescheduling versus restructuring. Rescheduling is essentially just saying, look, it's the same loan, you just get more time. It's a temporary time extension for a borrower in a bit of a bind, maybe right after a massive flood. Restructuring, though, that is a much deeper intervention. It means entirely redesigning the core terms of the loan, maybe slashing the interest rate or radically changing the tenure because the borrower is in serious structural financial distress.
Now, don't mix either of those up with refinancing. Actually, scratch that. Refinancing isn't about adjusting an existing borrower's loan at all. It's a lifeline for the bank itself. This is what happens when a bank goes directly to the NRB, borrows money at a wonderfully cheap concessional rate, and then immediately relends that exact money to national priority sectors, like local agriculture or businesses that got hammered by a pandemic. And to keep this whole complex engine running safely, banks rely heavily on these essential risk tools. The base rate acts as a completely transparent floor price for loans, meaning banks can't just invent arbitrary hidden interest rates. The CIB and blacklisting system, that's there to ensure serial defaulters can't just run away from one bank and borrow from another. KYC, or Know Your Customer, is the ultimate frontline defense against money laundering. And of course, audits are the retrospective reality checks, ensuring absolutely no one is cooking the books behind the scenes.
And finally, part 5, the strategy.
Let's get into the actual exam psychology. Here's the secret. Examiners literally only spend about 60 to 90 seconds scanning your subjective answers. I know, it's brutal. They are definitely not reading for pleasure. So to guarantee full marks, you want to use this winning structure. Start immediately with a crisp definition. Follow that up with a structured body of details. Critically, and a lot of people miss this, include a specific Nepal example. And always finish with a conclusion. If the examiner quickly scans and spots those 4 exact elements in 90 seconds, you win. It's that simple.
So, keeping that in mind, here are 5 absolute cheat codes, the specific habits of consistent Lok Sewa toppers. 1. Underline your key terms so they pop off the page. 2. Never ever leave a blank question. Even just laying out a partial structure will get you some points. 3. Time your answers strictly by the marks, budgeting about 7 minutes for a 5-mark question. 4. Like we just said, always write that conclusion. And 5. Practice active retrieval instead of passive reading. Listen, strict time boxing is absolutely vital here. Dropping your pen and moving on to the next question is always more valuable than writing a comfortable, overly long essay just because you happen to know the topic well.
All right, let's test this out real quick before we go. Imagine a rural entrepreneur desperately needs 50,000 rupees to buy a sewing machine to start a business, but they have absolutely zero collateral to offer. Which type of institution do they walk into? Think back to our players, got it? Yep, they go straight to a Class D microfinance institution. Why? Because those specific institutions specialize in small, completely collateral-free loans for the deprived sector by using a clever group liability model. You see, you now have a rock-solid grasp of the actors, the rules, and the language of Nepal's banking system. But here is a final thought I want to leave you with. As this massive financial system continues to rapidly evolve and modernize, how in the world will the NRB balance the need for incredibly strict safety regulations with the desperate, immediate need for fast, accessible credit in the most rural areas? That right there, that's the real puzzle to solve. Thanks for exploring this with us. We'll see you in the next time.